Hey guys, welcome to Mentorship Monday. This is Matt Faircloth. If you guys like what we do here on this YouTube channel, take a minute right now and subscribe to our channel and like this video. You're going to love this Mentorship Monday series. Justin, what we got coming up today?
On this video, we're going to tell you how to find a market. What trends do you need to be looking at to figure out where you should be investing? Also, it's a big double episode. So in our second question today, we go into how to cross-collateralize loans, how to find equity for your deals, how to talk to people and get them partnered with you so that you can find your next deal and fund it, which is most important.
Who do we have first up for Mentorship Monday? Let's do it.
First up, Jersey guy, Mr. Nag Ready. Nag, thanks for joining us today, man. How are you?
Thank you. I'm good. How are you?
What can we do for you today? How can Justin and I brighten your day, man?
I was a newbie actually into this real estate, so I'm just trying to, gather some, inputs like, the better markets.
Okay, so you want to know the markets in New Jersey?
Yeah, like 2 to 4 families.
Are you looking to do more high-end sort of rental, or are you looking to do probably what I would suggest is like multiple purchases of like a smaller house? Like, or what's your thought?
My plan was to start, like as initial, like in the medium scale.
Good.
And then from there to grow up.
Okay, so Matt, what we have here is NAG is approved for up to $700,000 purchase price. He's looking for a BRRRR type property. He is just getting started and he wants cash flow and appreciation. And he's trying to figure out which markets he should be looking at or how to evaluate the markets that he should be looking at. And sure. I think NAG, the first thing that we sort of said is, even though you're approved for 700, most likely you should not be going after a $700,000 property in the very first go around, especially if you're looking for cash flow and appreciation.
Mm-hmm. NAG, are you looking to live in the property too?
No, just for the investment right now.
Okay, good. So here's a few tips. You got to, and this goes to everybody, right? You got to go where the bubble is moving, right? And in North Jersey, what we're seeing is, and we're not, DeRosa does not invest in North Jersey, but I know a lot of people that do. And I read a lot of articles in New Jersey because we do own a lot in South Jersey. And I'm seeing what's happening in North Jersey because of COVID, it's being expedited. But this is something that was happening before, which is migration of families out of New York City into North Jersey. And we're also seeing people want to live, near commutable areas like rail stations and things like that, because it might still have to get into the city every here and again.
You're in Central Jersey near Freehold, huh?
Yeah.
Okay, great. I think if I can build on what Matt was saying is to look at the population growth, the trends here in New Jersey. Are you more comfortable with a property that you can drive by, manage, be close enough to, or are you comfortable, investing out of state, far away? What are your thought processes on that?
So initially, I just want to understand, what the tenant issues and all that stuff to, like a drivable distance. So once, I get in and out at least like a year, so watching the tenants. So from there, I just want to move out of state. So to start with, how to be in a, as a commutable distance to understand,
start the process. That's exactly what I did, right? I didn't even have any inclination about out of state or whatever, but I did want something that was close enough that I could drive by and sort of self-manage and learn the ropes, learn the process. So I picked the market. Frankly, I picked the market my first time based on the price, something that I could afford, because I wasn't approved for 700. So there was not, as much room for a deal as I thought. And I think Matt's back. So Matt, if you want to continue your thought process there on following the population, as you were saying.
Yeah, man. The only thing I would add to you said before about the access to rail stations, because the New Jersey Transit and New York Authority are going to eventually open up another tunnel to get into Manhattan, and that's going to increase a lot more rail traffic going into the city. From the current rails, they're not going to add any rail stations that I understand. They're going to just add a lot more trains going into the city from the North Jersey area. So I would do my investment if I were investing in North Jersey in and around those train stations and the cities that maybe have reasonably good school systems. So I would say I would cross-reference school system ratings and access to New York City by rail. And if you can build that out into a matrix, you should be able to pick a few cities to target.
That's great. And
Yeah.
Nag actually is in the Freehold area, so he's actually a bit closer to us down in Central Jersey.
So
Yeah.
you recommend like a Plainsboro or Princeton, those kind of areas? That's what you mean to say?
And north too. I would look at like
Okay.
Perth. Personally, I'd look at New Brunswick, Perth Amboy.
Uh-huh.
New Brunswick, you can get a good deal because you get at least to college students or at least to professionals that work at the hospital. And New
Uh-huh.
Brunswick is already a commuter city to Manhattan. It'll continue
Uh-huh.
to be so. So I would look where you are in Freehold, north. You could also look at the areas over by the shore, like the Red Banks and things like that.
Uh-huh.
That you can get on a boat to get to through the ferry system to get to Manhattan.
Uh-huh.
Yeah, so I love that. Really what Matt's saying is thinking about the demand in the future, right? We know people are going to be commuting. What we're seeing with COVID is that people are moving out of Manhattan and they're moving into Jersey and North Jersey. And what's going to happen is, at the closer you are to Jersey, the prices are going to get higher and higher. So people start moving down that train station, right?
Uh-huh.
They go station by station by station. Their commute gets a little bit longer, but they sort of cluster around that. And then you cross-reference that in with the school districts. And now you've got a winning town that you're appreciation. There's going to be a strong rental market. People, in an upturn, a downturn, people are always going to want to be living there. Good schools and easy access into the major city. So hopefully that helps you figure out, how to find, that's very Jersey specific for anyone else watching this, but outside of your town is probably the same thing. I expect people are probably moving out of the major cities and check those lines, check the subway lines or the train lines coming in and out of your cities and start to match that over with the towns.
Yeah, and you can also just transpose that to any market, follow the growth, and transpose because of COVID and because of growth and things like that. Where are jobs and people moving to? And in New Jersey, the Manhattan's going to continue to be the center of employment in New Jersey, but it's not going to no longer be the center of residential as well. People don't have to live there to work there anymore.
And by the way, if you're more comfortable in South Jersey, do the same thing with Philadelphia.
Yeah, I'm comfortable in South Jersey too because my wife has a clinic in Cherry Hill.
Perfect.
Yeah.
Mm-hmm.
So
we know a lot of investors down there crushing it. Same thing. Look at the stations, look at the growth, look at the schools.
Mm-hmm.
And I'll do a plug. Join the SJ RIA group. Your local RIA is a great resource. And in New Jersey specifically, SJ RIA is the group to be with in South Jersey. They are a great connection for you.
Mm-hmm.
Awesome.
Thank you so much for coming on the show.
Justin, doubleheader. Who's up next?
We got Jonathan coming in next. Jonathan, how are you today?
I'm doing well, thank you.
Jonathan, you're coming to us from Georgia, correct?
Yeah, Lookout Mountain, Georgia.
Excellent. Well, John, go ahead. Let us hear your question.
Sweet. So a little bit of background. My wife and I, we have a couple of duplexes and a couple of single family homes. And we've saved up a little bit to be able to probably purchase one or two more. But at this point, I'm really looking to get down into the details of how to structure deals. I think I've got a big 30,000 foot view. And so one of my big questions is it possible to get a private loan from a cash provider where they give like 25% where I'm doing a loan deal with them, like to pay them 8 to 10%. And then for me to be able to get a mortgage, the other 75% underneath my name or an LLC. Is that even possible? Is my big question.
Sure. So yes, because all you have is someone lending you money, right? The problem you have is collateral, right?
Correct.
And so let's address that. So the to say it in layman's terms, right? The bank is going to put a first position lien on the property, and a lender is going to step in and say, "Great, I'd love to lend you the money, but what do I do if you don't pay me back?" Well, I'll say I'm sorry. I don't know, right? Because you can't put a second mortgage lien behind that bank's lien without them accepting you doing that and being okay with you putting that second position mortgage behind them on title, right? So the problem you have is collateral. Now, what we did this very thing. We built a bunch of townhouses in Philadelphia where we had a bank come in and give us first mortgage position and a private investor come and do the second round of money behind. What we did was we agreed to pay the investor a flat rate of return, for in that case was 8% on their money plus a percentage of profit. Okay. So my guess is this is a rental deal or a flip?
I'm hoping to rent it. That would be, it could go either way, but I am looking towards the rental piece of like.
Are you going to do the BRRRR strategy? You're going to buy it, renovate, refinance, and then repeat?
Potentially. I am looking to maybe find it that's already got renters in it.
Okay. Got it. All right, it might be hard to burr. All right, so at the end of the day, whether you were going to do the collateral thing or whether you're going to do the percentage of equity thing or not, you need an investor that's willing to stay in the deal long term. The cash provider that's willing to not. This isn't like a 6-month offer. This is a 3 to 5 year deal.
Correct.
Right?
Yes.
Okay. So this is a straight equity deal. This is a security, an SEC registered security, unless they're willing to do something as part of the company. So this is fairly simple. You're going to give them just set up an LLC. And this is, Jonathan is Awesome LLC. And then you're going to give that investor you're going to sell them shares of the LLC or sell them a percentage of the LLC. You have a local attorney set it up for you. My book, Raising Private Capital, talks a bit about how to do it. And then at the end of the day, that's it. So you're going to just do a straight syndication. My first syndication was on 2 single family homes with the investment being $50,000. Right. Okay. So it doesn't matter how big the deal is. So before you talk me out of it and say, hey, wait, Matt, I'm not buying an apartment building. Well, I get that, but it doesn't have to be that big to be a syndication. You are selling a security unless that investor has an active role in the investment. So if they are keeping the books, if they are co-signing the mortgage for you, if they are doing something to add value and doing some of their own efforts, then it's a partnership. But if they're doing nothing, if Jonathan's doing all the work, then it is a security because they are making their money. They're making a return on their money from your efforts.
Got it.
Okay.
Now that's if they have equity in the company, right? Or equity in the project. What about debt, Matt? Is there a way that we could do this with debt, even though they can't be second position on the mortgage? I don't like you can, but it's not, the investor's not going to like it. And that's with an unsecured line of credit. That's to say, hey, I'm Jonathan and I'm awesome. And I promise I'll pay you back. And they give you $50,000 or whatever on your word and on your personal credit and on their rights to sue you if you don't pay them. If you own other real estate, Jonathan, with some equity in it, you could collateralize that other real estate.
Got it.
Okay.
Yeah, got it.
And then, like, let's say you got your primary residence or another rental property. Mm-hmm. Okay. You could put a lien on that property and then take that money and then put it in your next deal.
Yep. Got it. Brilliant.
Are you in that situation? Do you have?
I do. Yeah. So we have, a couple of properties that I could do that. I was even thinking to take their money and replace my money that was in one of those properties. Does that make sense? So to put it in there, Then when I get my money back out, then put it in somewhere, find somebody to replace that deal, pull money out. Does that seem legitimate?
That's fine.
So refinance, you're just using private lenders for it. Right.
Well,
correct.
Here's the thing, Jonathan, is I would consider this. If you've got significant equity, the cheapest money you're going to get is a HELOC.
Right.
A home equity line of credit. So I would investigate, and banks will give you a HELOC on rental properties if it's the right bank. Okay.
Right. Okay.
So consider a HELOC first, because the HELOC is going to be way cheaper than any investor rate of return is going to want. Investors are going to want 8, 9, 10, right? percent, if not more. I would look into a home equity line of credit. And then look at investor blend-ins, right?
Right.
So we got a lot of options here, right? Equity partner, joint venture, putting together a mini syndication, cross collateralizing your loan, HELOC. There's definitely some options here to get you.
If you got equity, is the lesson, guys. If you have equity, then it's certainly you want to tap that equity to use it to borrow against it. If you don't have equity, you're going to have to give equity away in your new deal.
Yeah, brilliant. Thank you so much for your time. I'm very appreciative.
You're welcome. I won't let it go to my head, Justin. You hear he called us brilliant, Justin?
Thanks, Jonathan.
Awesome. Another great episode of Mentorship Monday, guys. Thanks for watching, guys, and have a great and profitable week.